Well, the markets are doing pretty well this morning. So let's focus on another sector that could do well from here on. It's had challenges in the past. That's the cement space. Orient Cement. Well, the volumes have come in marginally higher on a year-on-year basis. There's a sharp contraction in terms of margins. Joining us to break down the numbers and also what's the way ahead, the MD and CEO of the company, Mr. Deepak Khetrapal. Hi, Mr. Khetrapal. Well, what's happened? We were well aware, in the past quarter. So the street was bracing for this sort of a number. The question is, what happens from here on? So to get straight to the point, you were guiding for volumes, I think, of around 6.1 million tons odd, and the EBITDA per ton of close to around, 1,000, 1,100. Do you hold on to that guidance, sir?
Nigel, thank you once again for having me and being able to sort of have the opportunity to explain something that happened and how things are going to go from here. Well, we've had a very, very difficult and I would say very disappointing quarter. I mean, we knew that last year's EBITDA could not be repeated. We knew that we had 188 crores, closer to 1,400 rupees per ton. I think we were aware that it's not going to be repeated even before what hit us in the rest of the year. But where we have ended up just over 100 crores is also very, very disappointing. And if we look at the numbers, the details are very clear. Available. Not that we've gone wrong in terms of our market share, not that we've sort of lost market share. The volumes have been soft in the markets that we've been there. The challenge has been from the cost push side. And we've been aware that this is very much in there. Nobody could escape it. In our case, it looks even more jarring because we were managing to, I would say, stay much below the cost levels of the many other industry colleagues. And finally, the law of averages had to catch up, and we have the cost and power and fuel cost, which has been always our pride, how we manage that. That crossing 1,600 rupees a ton hit our bottom line. But if we compare that cost with the rest of the industry, I think we're still doing much better. I mean, from what we've seen from the numbers of all our other industry players, the cost pressures, while they have not gone away, but we are beginning to see some sense of softening there. And for that softened, I would say, fuel prices to kick into a P&L, it obviously will take a couple of months, maybe 2 months or 3 months till we run out of the inventories that we have procured and have covered with ourselves. So some light at the end of the tunnel on the cost front. On the volume front, which obviously is important for our operating leverage perspective, we need to wait for the monsoons to get over, because in the month of July, what we've seen of rains in almost all our markets that we operate in, whether it's Telangana, Maharashtra, I mean, most of the markets have been flooded for most of the month. So it's been, I would say, not a good start to the Q2 that we are running through. But looking at the basic fundamentals in the economy and looking at the kind of growth that some other markets in the country have seen in the month of June, in the month of July, I'm talking about markets in North, I'm talking about even markets in West, markets like Mumbai, Gujarat.
I'm just going to interrupt you because we're short on time. So I just wanted to get a sense in terms of a couple of numbers. You said that your current cost, because of freight costs, etc., was around 1,600 rupees per ton. Now that you're seeing some amount of softening, where do you expect it to probably average out in the next 2 quarters? And you've not been in a position to take price hikes to probably negate some of these this cost impact?
Well, obviously, the ability to pass on the cost to the customers is a function of the demand being robust. And in the markets that we are operating in, the demand has been very poor and the costs have not been passed on. Relatively speaking, some of the markets, markets in North, if we believe, or some other markets, the prices have gone up because the demand was more robust. So we need to wait for monsoon to play out, let the demand scenario become clearer, and then we'll be able to sort of pass on the costs to the markets for sure. In terms of how much reduction, well, coal costs are looking softer by just about, I would say, 5 to 7% over what we had seen in the previous quarter. So that's only power and fuel costs. I'm not talking about the other costs. So 1,600 rupees a ton was, to clarify, power and fuel costs, right? And on that, softening is happening. Other costs are thankfully not going up anymore. But the major thing which will depend, on which our performance will depend, is how the volumes grow and how the pricing moves.
Okay, but Mr. Khetrapal, you say it as it is. Last quarter is disappointing. You're calling it out. Given the kind of challenges that you have, do you think that 6.1 million tons is possible?
It is very much possible, Nigel.
Okay.
My only, and as if you remember when we spoke last, I was saying volumes I'm still not giving up on. On pricing, and because of that, the EBITDA overall, I'm beginning to get a little bit concerned because our Q1 has not provided us the platform that we needed to exceed 1,000 rupees of EBITDA per ton. So unless we really see strong volume growth going from here onwards, at least in the second half of the year, which enables us to recover the increased costs, that 1,100 rupees ton is something which I'm beginning to get concerned about, for sure. Okay. But again, it's too early to suddenly get completely disappointed with what's happened in Q1 and to in a way extrapolate that for the overall year. I think it's still a little premature.
All right. So, you are sounding a little cautious. You're waiting for probably some kind of signs of volumes to pick up as anticipated. What does this do to your plans for debt reduction? Because you had guided that maybe in the next 6 to 8 months or thereabout, you would probably be debt-free. Do you think that would be pushed back simply because of the business scenario currently?
Yes, obviously debt reduction can happen only from the operating cash flows coming in, right? And those have been under stress. The Q1, if we had gone wrong by 50-60 crores out of the total debt, today total debt is already down to, I mean the project debt, the term loans that we had taken for the Chitapur project, that obviously have come down to 260 crores as on 30th of June. But parallelly, what's happening is because of the increase in the costs of fuel and also because the business has taken a little longer cycle in terms of cash turnaround, the working capital has definitely gone up in the first quarter. And that obviously we're now having to borrow money from our working capital limit from the banking system, which we had not used for years together. So while the debt repayment schedule will be respected, our expectation that we'll be able to completely repay the entire term loan within a short period of time will get impacted by the cash flows that we have. There is no other way to reduce that.
Okay, all right, Mr. Khetrapal, now we'll have to debate on pricing, on cost, on volumes going ahead. But my question to you is, the street is looking for value stocks. And Orient Cement could be perfect for that. Going by your multiples, going by the EV per ton. How are you going to change this perception? How are you going to get a bigger multiple? I've asked you this before as well. You've ruled out a buyback. You're saying you want to focus on volumes. What's the plan from here on? Orient Cement, is it value? Is it a value trap? Go ahead.
Nigel, let me tell you where this so-called undervaluation, largely whenever I've spoken to investors, they've been worried about our very narrow exposure to the markets in South and the parts of Maharashtra. The biggest news, which perhaps you may not have noticed so far, is that in the last 10 days, the Rajasthan mines that we've been sort of I would say battling with the Rajasthan government to get back, they are being restored to Orient Cement. Those mines coming back with significant limestone reserves gives us an opportunity to create a greenfield capacity in Northern India market, which happens to be one of the most robust markets that can get to. So in terms of, I think if the anxiety of the investors was largely around, oh, you're stuck in a market where there's too much oversupply and you'll never be able to sort of really be able to perform as well as the pan-India players, I think that give us a little more time. We are getting the mines back. We'll put up a greenfield project and we will become more diversified in terms of markets exposures. I think if nothing else, that should start getting the investors interested in Orient Cement because getting a capacity in Rajasthan is one of the best things that can happen for us.
Got it, Mr. Khetrapal. Noted your points. South and West, you say maybe you're going north. Hopefully the stock price moves north in the times to come as well for those that are bullish on that. But we take all your points, very, very valid arguments. The stock for the time being more or less flattish because the street was anticipating a weak quarter.